Joined by Xavier Denis. He is an economist and strategist at Societe Generale Private Banking. He joins me now from Singapore. So some conflicting views, Xavier, about the health of the U.S. economy, whether or not QE2 has worked, and whether or not it's time to exit that ultra-loose monetary policy. What do you think?
I think that first of all, the U.S. Fed is likely to achieve its quantitative easing 2 program that will come to an end late June. However, I think that probably the market is too complacent by considering that the Fed will remain on hold for the quarters ahead. So I think that probably the Fed is likely to act certainly sooner than initially expected by the market, considering that economic recovery is relatively strong and solid in the US, and also considering that core inflation is likely to probably to creep up further.
But Ben Bernanke has repeatedly said that he's not concerned about inflation in the U.S. He says he's watching it. What makes you think that we're going to get a rate hike from the U.S. sooner than expected, and when will that rate hike come? Markets tend to consider that nothing is going to happen on the Fed side before mid-2012, or even in some cases before the end of 2012. So I think that if we get some positive data regarding the labor market, if oil price may continue to increase or may continue to be relatively high, I think that could be ingredient for the Fed to quicken the pace for monetary policy tightening. It's still not on the cards, but I think it's an increased probability. Okay, so as the ECB switches gears here to tightening and the U.S. contemplates the same, what kind of a knock is global growth going to take in the second half? Regarding the ECB, I think that it was not really a surprise, since Chairman Trichet decided to change the tone of the communication of the ECB. However, I would be probably a little bit more cautious regarding the speed of recovery at the global level in the second part of the year. I think probably there are some downside risks that have been so far largely overlooked by the market. The fact that oil price may squeeze corporate margins. Oil price is also likely to affect consumer purchasing power. So I think the second part of the year may be more volatile and more tricky for the policy-making process. What does it all mean for markets? We're about to hear from companies on their latest quarterly earnings. Those are expected to be strong. Do you see a correction in markets? Where is investors' money best placed right now? For the time being, I think that valuation remains pretty much attractive on most equity markets. So the main issue is about inflation. Inflation is really taking hold in emerging markets, especially in Asia. So that will call for further monetary policy tightening. And I think that we may continue to see some disappointment regarding Asian equity market, at least in the short run. So when we see some inflation stabilization, I think it will be time to return to the equity market, especially in Asia. Regarding developed markets, I think that prospects remain relatively bright, and I think that it's relatively good news to see that in spite of negative factors or very sad events that took place in Japan, for instance, in spite of also the still boiling the euro debt crisis, equity investors have been largely immune from this kind of fear. Xavier Denis from Societe Generale Private Banking, we thank you very much for being with us.